Right. Macros. So and today we're going to be talking about macros. We're going to be talking about macros only in the New York session. So we'll be doing macros from starting from the 850 to 910 macro, and we'll go all the way up into the end of day macro. So let's get right into it. Macros, first of all, macros are the last 10 minutes of your hour to the first 10 minutes of your hour. And there's theory behind this, but I won't get into that. And there are a couple more in the PM session that are a little bit longer, but generally your macro times will be at the last 10 minutes of the hour to the first 10 minutes of the next hour, so it'll be 20 minutes in total. And what the macros are is that they're just points in time that are coded to have certain things happen. They're coded to run liquidity or rebalance imbalances, and they are also coded to give you a entry drill in pretty much every single macro. We'll talk about which macros to look at and what happens if certain things happen in certain macros. So we'll get right into it. So the first thing we'll look at is we'll look at that 850 to 950 macro here. So let's get that up. I mean 850 to 910 macro here. So let's do that. Down here, bring it down. Okay. This is our macro. We start at 850 here. Let me see if I can find the shit. Actually, no, I'm not doing the shit. We're doing something else. Okay. You can do it like this. So this is your 850 macro here. I don't know if you guys can see this, so I'll make it just a little bit bigger. So this is your 850 macro start here, and this is your 910 end macro here. And this is your first macro of the New York session in the pre-market. In this macro, you're not really going to be looking for anything. There are entries that can be put up into here, and that is exactly what this macro is used for. So we have some relative equal lows here. We have some lows, short-term low here. We have another short-term low here and some relative equal lows here that we quite didn't get to until later. But once again, what are the macros used for? They're used to give you an entry drill, rebalance inefficiencies, or run liquidity. So what happens in this top part of the macro here? Well, it gives you that entry drill right here. You get your fair value gap, or if you want to say, yeah, BPR. You get your BPR entry right here, right on that macro. Now you can front run the macro by 1 to 2 minutes here. So you can look for your entry anywhere between the 48 and 49 mark. However, you will most likely get that entry on that 50 mark as well if it is going to do it, because the macro is coded to give you guys an entry model, right? So there's your entry model right there. And you can see right before the macro, we kind of ran through this one. This SIBI here came up to this higher SIBI before coming down here. With the macro, you don't really have to worry too much about that because it's going to give you that really good entry right there. Right, so it gives you that entry and it comes and it runs these two relative equal lows here, leaving this third one as a relative equal, but there it is, right? In that time, it's coded to run that liquidity and to give you that entry drill. So let's move on to the next macro. The next macro will be at 950 to 1010 here. So let's mark that out. 950 to 1010. Okay, so basically what this macro here, it's coded to do the exact same thing, give you an entry drill, as well as to run liquidity or rebalance inefficiencies here. So the problem I have with this macro is that in the middle, you do have that 10 o'clock news driver, which is this right here. So I like to avoid this macro if possible when you are looking at when there is 10 o'clock news of an orange folder or higher. Now, what this macro usually does here is at 9:30, you're going to have your Judah swing either higher or lower. What that's going to do is it's going to give you your Judah swing. So it's going to do a fake move. And what's going to happen in this macro is it's going to come above that Judah swing and kind of give you that entry off of that Judah swing, all right, into the true move of the day here. So that's kind of the idea behind this macro. I don't use this macro too much just because it does get a little hectic with that 10 o'clock candle here, right? And you can always wait until your silver bullet hour, which is right here. But as you guys can see here, because we had this news driver, it really did not really give you any good entries. Yeah, maybe you could have taken this breaker right here. You had the breaker here, you had the order block here, right? So a couple entries you guys could have gotten right here. that it did provide you guys even a turtle soup down here, and you could probably find like a 2-minute fair value gap, maybe a 3-minute. I guess not, but it does offer you that entry model right there, and it does come and run out this liquidity here in this macro here, all the way up here, and finishes up here with this one right at the end of the macro. So let's move on to our next macro, and our next macro is going to be from 1050 to 1110 here. So 1050 to 1110 here, and now this macro has can do one of two things depending on the day. You're going to see, if you see this macro consolidate, we're going to be looking at the next macro. And if the next macro consolidates, we're going to be looking at the macro after that. And I'll kind of get over it and into that as we kind of go forward. But this macro should have these same exact things apply to rebalance inefficiencies and to take out liquidity. So what did we have here? We did have price in this macro come and rebalance this inefficiency that was imbalanced here, right? This part of the inefficiency that was imbalanced here, this inefficiency that was unbalanced here, and this inefficiency that was imbalanced here, right? So inside of this macro, we've rebalanced every single one of these inefficiencies here, right? We traded to and through them and every single one of them, right? And did it give you an entry model? Yes, it does give you a few entry models here. I'm just gonna note, I'm pretty sure there was SMT here where ES came into its fair value gap. There was a 30-second entry here as well. But yeah, these were the imbalances. It fixed right there. You did also have this breaker block here. If you wanted to take it here, right, it gives you that breaker block entry right there. Gives you this order block entry one right here one more time. But the main idea with this one is that we managed to sweep that liquidity here, right? Less focus about having us give it the entry model, right? Because sometimes it's not going to give it to you. But what it is always going to do is rebalance inefficiencies or rebalance or seek liquidity. And that's what we did exactly in this macro. Every single inefficiency was rebalanced in this range here, right? So there you go. That's this macro here. And let's move on to the next macro, which would be from 11, 10, yeah, 11, 10, 1150, sorry, to 1210. And now this is the macro you want to look for if your AM session is consolidating, right? So if your AM session consolidates, not something like this, but this is where you're going to want to look for your entry if the AM session consolidates. Now, if the AM session, meaning the 950 to 1010 macro consolidates and continues to consolidate in the free time here, and then the 1050 to 1110 macro consolidates, your best entry is going to be here. Now, if you don't see that consolidation happen, this macro is pretty much not going to do much. It is going to do the same thing, but it's not going to be as clean, and you will see that kind of right here, but it's still going to do the same things here. Left these relative equal highs here. No clue if this is SMT here. We have a whole bunch of inefficiencies down here, right? That literally did not do anything here, right? And we know that this macro is not going to do anything, right? If we did not consolidate during the AM session. So this macro is practically useless unless we did consolidate during the AM session, and this is coming into your lunch hour, right? So now let's move on to the next one. And you do technically have a macro in the lunch hour. I would not look too much into it. Once again, it is going to be a 1250 to 110 macro here, right? And it is going to do the same thing, rebalance inefficiencies and seek out liquidity. And we can see we kind of ran these low resistance liquidity here. See, right when this macro started, we kind of got that movement there, right? And the next macro again, which I wouldn't hold too much emphasis on, but you definitely can, would be this 1050 to 210 macro, right? This is a Friday, so this is going to be a lower probability at the end of the day. So I'm going to move on to a different example for our PM session here. So let's get into that. Maybe we'll try Wednesday here. Actually, I don't think it's a very good week because it's kind of like on news driven. But yeah, we can probably look into Thursday here. And Thursday will give you a good example of everything I talked about again. So we have that 950, right, to 1010 macro, right? And what did I say is going to happen in that 950 to 1010 macro, right? You're going to have your 930 Judah swing, which sent us lower. The second this 950 to 1010 macro started, right? You can see us run that Judah swing high, right, in that macro there, right? Beautiful. And we did one more short-term high, ran right there. So this is your 950 to 1010 macro, and this is what's usually supposed to happen during that time. Now we'll do again really quickly the next macro, which would be the 1050 to 1110 macro, right? And this 1050 to 1110 macro does offer you that entry drill. So does this right here. So does the 950 to 1010 one, right? It offers you this fair value gap here. It offers you this change in the state of delivery right here. It offers you a couple order blocks here, an inverse fair value gap opportunity, and a breaker block opportunity here, if you so choose to do. So there's your entry models here, right? Coming into this leg right here, right? What's the goal? Rebalance inefficiencies or to seek out liquidity. So what did we do here inside this macro? We rebalanced these inefficiencies here. I remember clearly there was SMT down here, so that was most likely the reason why we did not run this low. Yes, we did run this low here, right? And it gave you an entry model for not only going short down to this low, but it also gives you an entry model long here up to these highs. And you can see we right after this macro, directly after this macro happened, we took this liquidity, we started consolidating, right? We consolidated. Boom, come into the macro. Here's where we have the move here. Boom, right? Entry, entry. And you guys could have, depending on what your bias is, you guys could have your trade and you guys can hold the trade. So your best times to take trades are in these macros here, right? And something kind of cool about macros is that if you split them in half, if you split them in half, sometimes you will see that one thing will happen in the first 10 minutes of the macro and something else will happen in the next 10 minutes of the macro here. So, and that's exactly what we can see here. We see in the first 10 minutes of the macro, you had that downside come in, and then the next half of the macro, you had that upside come in, right? So let's look at the next one, which is the 1150 to 1210 macro. One more time. And once again, remember what I said about this one. If we did not really consolidate during the AM session, especially in these macros here, this one is most likely not going to see that much happen into it, right? And that's exactly kind of what happens here. We did not see that much, but we know that the algorithm is coded and to spool and to take liquidity here. So what happens inside of this macro, right? Just a couple minutes after the macro starts, 4 minutes, we just start spooling upwards and finally taking out this high here. So let's move on to the next macro here. I'm gonna skip this 1250 to 110 macro because I just really don't put much emphasis on it. So your next macro is going to be from 1050 to 2 o'clock macro. And this is going to be your macro coming into the PM session here. And this macro is really what's going to set up for what happens inside the PM session here, right? So in this macro, you get your entry drill to go higher, but you also get your entry drill to go lower here, right? And also, what is the goal of the macro here? It is to rebalance your imbalances here, right? So right as this macro started, we rebalance this imbalance, rebalance this imbalance, rebalance this imbalance, and rebalance this imbalance here, leaving this as a breakaway gap, right? And what can we notice about this macro here? Let's split it in the middle, right? You had the first 10 minutes of macro spool higher, then you had the next 10 minutes of the macro spool lower, right? I would keep the high and the low of everything in this that happened in this macro. I'll mark it out, happened in this macro on your charts here, because this will set up pretty much a good amount of what will happen in your PM session here. Your next macro is going to be from 250 here. And this is kind of where we get into power hour, and I'll explain power hour in a second. 250 to your 310 macro here, right? This macro is pretty much the same as all the other macros. It's coded to do the same things, rebalance inefficiencies and seek liquidity. And that's kind of what we kind of see here. It's not the cleanest here, but you do get your liquidity sweep here, your liquidity sweep here, as well as your liquidity sweep up here and up onto these highs here, right? Although not the cleanest, you do get them all in this macro here. So let's move on to the next macro, and this next macro is going to be a little longer. It is going to be at your 3:15 to 3:45, and the reason why this is called power hour is because there's only around 10 minutes of time between 2:50 and 4 o'clock where you're not going to see a macro be put in place. So this is your next macro, and in this macro here, you're specifically usually on a good day, on a higher probability day. Note this is the day, this is a Thursday before PPI, so not exactly your most high probability day, right? You're supposed to see this run either your sell stops of lunch, which would be around here, or your buy stops of lunch. Generally, that's what it's supposed to do, and we don't really see that happen here. Now, our final macro here is going to be from 3:50 to 4 o'clock here. And the reason why we end up 4 o'clock is because it's the closing bell here at 4 o'clock here, right? Once again, you do have your times with there is no macros here, right? These are your 5 minutes, but generally, you're going to be if you're taking a PM session trade, you can be taking a PM session trade anytime during this time, and it's just going to be in the macro here. And this is your final macro from your 3:50 to your 4 o'clock macro. And the specific name for it, I forgot. It starts with an H. I forgot about it, but this is designed to pretty much do the exact same thing here. And you can see, right, the second we take out this liquidity in the macro, we take out this liquidity in the macro, we rebalance this inefficiency here in the macro, right? So that's all the macros are coded to do. They're coded to either give you an entry model. They don't always have to, but usually they do have an entry model, rebalance inefficiencies, and seek liquidity. Do we have any questions about macros or anything like that? Yes, the 950 1010 is also the New York Open 4-hour candle close. Yep, that is true. Do we have any questions about the macros? If we don't have any questions about the macros, then that'll pretty much be the end of this session. All right. What is my entry model for the macros? Well, my entry model really depends on the day and kind of what is happening, but I'll go over the trade that I took actually in this macro right here for you guys. So this was on Thursday. Right here. This was on Thursday here, and so this was the macro here on Thursday, and I was looking for these news highs to get ran here, as well as these highs to get ran right here, right? So this was my draw on liquidity here, this high, and this high here. So what was I looking for inside of this macro? I was looking for it to ideally run sell side or give me an entry model to go higher. What did we have here? We ended up having SMT with ES here. You guys can check it if you guys don't believe me here, but we had SMT with ES here, right? And with this becomes your low risk buy here. I didn't personally buy here because I wasn't convinced with this SMT it could still come lower here. But as we started to push higher, right? And if you guys do look at my ICT Gems channel or my Gems channel here, you'll know why this inverse fair value gap here is your high probability fair value gap, inverse fair value gap here. So we had this inverse fair value gap here. We had this fair value gap right here that was also in it here. I'm just going to turn this into a BPR here, right? I'm very simply put going to turn this into a BPR. But remember, this is your high probability inverse fair value gap right here inside of this macro here. Not only did you have that, you also had your breaker block right here. Now with breaker blocks, if you do have a fair value gap interlined with the wick here, you don't have to use the bullish candle in this case, right? And what I did was right out of here at the end of the macro here, coming in towards the end of the macro, I took my long position and I took it all the way up to these highs here. Right. So with what in short, what happens with the my entry model when it comes to inside the macros, I usually just look for, usually a fair value gap or something, or a little something with a little bit more context. But I'm cool with just taking a fair value gap as long as I know that my draw on liquidity is correct. And oftentimes I do look and wait for the macros to take my entries because in my journal that That's where usually I get hurt. Yeah, so how do I know my stop loss is safe here? Well, there's two reasons why I know my stop loss is going to be safe here, right? You have two options for your stop loss here when it comes to entering on a fair value gap according to ICT, right? You have your first one is going to be right here. And why is this okay? And why did I put it here instead of putting it somewhere like this low down here? Reason why I put it here is because first of all, we had this balanced price range here as well as this fair value gap here, right? Now, when I see a unicorn model with a balanced price range right here, especially when we have this high probability inverse fair value gap, you can totally put your stop loss underneath the candle where your entry is going to be in if you have a fair value gap. For example, if you have a fair value gap right here, right, your stop loss is right underneath of the candle that formed the fair value gap as long as you have high probability context to go into it. Now, what is stopping price to go lower if it really wanted to here? Like, what's the difference between if I put my stop loss here down at this low versus up at this low? What additional things are going to stop it from happening here? Well, let's look at this low, for example, here first. First, we have this breaker block, which we're using this candle here because it's inside of this fair value gap, right? So we're good to use this candle here. But if price really wanted to, it could come down lower into this breaker block here. So I still have this breaker block pretty much covered, right? Now, what do I also have? I do also have consequent encroachment of this wick here, just in case price wanted to come down lower, add consequent encroachment of this wick here. And that was enough context for me. I had a breaker block here, an BPR here, more of a fair value gap here. If price wanted to come a little bit lower here, we had another breaker block here. Now, let's see if I put my stop loss down here, right? What do I have extra that's going to protect me? Well, yep, I do have this order block if price really wanted to come down into here, right? I do have this order block, and I do have this consequent encroachment of this wick here and this consequent encroachment of this wick here. But in my opinion, because of this setup, I did not need to put my stop loss that low. So basically, when you are looking at a fair value gap, you really have two options for a stop loss placement. You have, depending on your context, right? You have this stop loss here at the bottom of the fair value gap candle here, and you have this option here, and you just have to determine the two based off how confident you are and what are the confluences in your setup here. Does that make sense? Now, something you could also do here is, for example, we have this fair value gap here, right? Once again, in the macro, right? How confident are you in this fair value gap holding here? Well, you can have your stop loss right here, right? Something else you could do for your stop loss here, if you wanted a little bit more aggressive or a little bit safer, you can get your measurements from this high to this low here and put it here. But generally, my two stop loss placements when entering on a fair value gap is either going to be the candle low of the fair value gap or the first candle. For example, you're going to have three candles basically to form a fair value gap. You have candle one like this, right? Candle one. Okay, what the fuck? Okay, there we go. Candle one, candle two, and candle three. Let's just do something like this. Right? So basically, your two stop loss placements are, in my opinion, right, that are going to be safe, right? And let me just put this here, right? Your two stop loss placements are either on the bottom of this candle, and this will all come with experience and depending on what other PD arrays you have and what defenses you have here to continue going higher. My stop loss is either always below this for this candle or this candle. It doesn't matter if we had this candle down here was the one that swept liquidity here, right? My stop loss will always be below this candle. Now, if we had something like this, where we had we were anticipating a breakaway gap here, right? I would put my stop loss just right below consequent encroachment of this fair value gap, because if this is acting as a breakaway gap, price should not come and trade below the consequent encroachment of this fair value gap. Does that make sense? What would have invalidated this trade? Yeah, awesome. Yeah. So what would have invalidated this trade for me here? Or which trade are you talking about? Are you talking about the specific trade that I took here at the in this macro? Or what would invalidate a trade in general? What are you more specifying to? This specific entry model? Well, that's the point of your stop loss, right? Where would you be, where, in your opinion, if price were to go down to, where would it be invalidated? My trade idea would be invalidated here, right? So my trade, for me, my trade would be invalidated around somewhere right here. And the reason why is, price can wick down to here, but in my opinion here, right? And you just have to judge by whatever PD arrays you're entering off of. With this breaker block here, with this inverse fair value gap here, and with this, even if you wanted to consider this your breaker here, I don't want to see price come any lower than this. If price does come lower than this and runs without me, I'm perfectly fine. But for me and my personal entry model here, I just believe that if price was to come down below here, that for me, my trade would be invalidated and I'll look for another setup. Because especially in the macro here, I'm not expecting for price to come down any lower. Does that make sense? Especially since we have shifted structure here. So if we're assuming that we shifted structure here and this is your true market structure shift, right? You should be allowed to take the first fair value gap that forms just like so and to go higher. Does that make sense? Yeah, I do. I do implement market maker models into my into what I base my trades off of, and of course, it all does have to happen in a specific window, in my opinion. But yeah. So I always like to wait for the macros because that is going to be your highest probability and your best chance of getting your entries and getting the best entries, and that's what I found personally from my journals when I am not trading. I have the lowest win rate when I am not trading inside of these macros, right? So unless you're really confident in something that's going to happen here, right? Wait for those macros to happen. And I can go over um the sell that I took here off this market maker model here, which was a very quick sell model. I actually ended up taking a rejection block short here. We're at this high, and I can kind of go over why I thought that this was kind of the high that I thought we were going to stop at here before getting a retrace down. I took it to around this low here, right? And this is pretty much part of your market maker model here, right? You have your market maker buy model here. You have your buy side of the curve here, right? Buy side. And then you have the sell side of the curve here. So I was just trying to get, or in this case, it would be like here. Let me see if I can get what's the tool for it? This curve tool here, right? So this is your buy side of the curve here, right? And this mini market maker sell model here. And this is going to be your sell side of the curve down here that we're going to be forming, right? So what made me take this trade in this specific time, even though this was not a macro? Well, the idea behind it is that we swept out this liquidity here, right? We swept out this liquidity here and we came into this fair value gap here, right? This unmitigated part of this fair value gap here, right? And we saw, what did I see? What was I looking at here? I was looking at this when price came into here. I was looking at how initially when we came into it, we kind of rejected that area right here off the 5-minute. So what happens is you come down into your 30-second time frame for your market maker model here, right? And you have your rejection block right here, right? And this is your rejection block for your first entry, because if we're looking at market maker models, how do your market maker models first start, right? You come from a high or a low. Then what's going to happen next is it's going to come into a rejection block. Then it's going to come into an order block. Then it's going to come into a liquidity void, but we're not going to worry about that because that's basically the same as a fair value gap. After it comes into a fair value gap, you're going to look for that breaker and you're going to look for the mitigation, right? And this is exactly kind of what happened here, right? We came up to a higher time frame PD array here, right? We made that high, right? We swept liquidity at this high here, came down, came into your rejection block, right? After coming to a rejection block, it comes into an order block. After coming to an order block, it comes into a fair value gap right here. After coming to a fair value gap, it comes into a breaker block, which would be down here. I guess it'll be cleaner on the 1 minute. Maybe here, let me see. But this is kind of your idea with your market maker models, right? And pretty much all my trades are based off market maker models. This trade was based off a market maker model. Um, this trade was based off a market maker model, right? With this being your smart money reversal here, right? If we're assuming this is going to be your smart money reversal here, right? This would be your first stage, and this would be your second stage. Yeah, let me see if I can find a good example. I did showcase that in the last video, that was published by RLE in the last week's class, but let me see if I can find another good example of it here. Because this was a decent example here, but I feel like we didn't really come into a clear order block, so that's why I would like to change it up here. But I think this is cool. We're cool with this here. So what happens here is we come up and we make a high, right? After we make a high here, right, we should have a rejection block that is made, and we have a rejection block that is made here, right? What confirms this to be a rejection block here? Well, it's a rejection block right here of a swing high. What also happened afterwards, we closed below the body of this candle here. So this is your rejection block now after this candle has formed and closed, right? Price comes up, taps the rejection block. Where the fuck did that text go? Okay, I'm gonna redo this. High, low, rejection block, order block, fair gap, breaker, and mitigation, right? So what happens here? Price comes into your rejection block here, right? So this is from the high. We made a high here, or, we could also sweep a high. SMT is usually preferred here, either like this or like this. So the idea is you're either going to sweep the high or take a rejection block. And the idea is that there's going to be SMT somewhere like here, right? SMT here where ES comes and takes the high, validating your high, and something like NQ shows the weakness and gets your rejection block. Now we do have a different type of form of SMT, which you have something like this, but I probably won't go over that. But we do have your rejection block, right? So next you're looking for your order block after your rejection block happens. So what happens after you form this order block right here? Boom, you get your order block right after your rejection block here, right? So this is the order in the way that it should react off your price come into a higher time frame PD array. In this case, it was the 5 minute, right? You have your rejection block, you have your high, you have your rejection block. Next comes the order block. We see that order block come into play. The next one should be your fair value gap. We have your fair value gap that comes into play, right? Your next one should be your breaker block here, right? You have your breaker block in play, right? And this is kind of the way that everything should form. Now, when it comes to the breaker block and the fair value gap getting hit, it's here where you can kind of have a little bit of interchange here, where the fair value gap does not have to get hit before the breaker block, right? This is the idea of where everything should form and where everything should react off of here. But you can have something like a unicorn and you can have something like a fair value gap that's not exactly inside of this breaker here. So these two, you don't have to look for it to be exactly together, and they're kind of interchangeable and they don't have to be exactly correct here, right? But you have your fair value gap and your breaker block here. In this case, we made the fair value gap, then we made the breaker block, right? So that validates this here, right? So we validated the high and the low. We validated the rejection block here, right? We came in, we got the rejection block here. We validated the order block here, right? We came in and we reacted to this order block here. Now the fair value gap and the breaker, right? What did we just do to these two, right? We just validated these two in the fair value gap and the breaker right here, right? And your final one is going to be this mitigation block in your market maker sell model. And this is in the idea where every single PD array should form, and each PD array should my fault, I just got rid of this. Each PD array should respect and come into this. So your first telltale sign that this sell model was pretty much over was when we failed to react to this mitigation block. And this tells you that this was over and that we had a new smart money reversal here. Does that make sense? So we had our rejection block, our order block. Now we can classify this pretty much as a smart money reversal once we do our shift in structure here, right? We shifted our structure here, right? What happens after you shift your structure, right? You can take the first fair value gap, boom, that happens. You have your breaker that's aligned in here. Once again, fair value gap and breaker is interchangeable, right? And you have your mitigation that should form. And your mitigation here should act here as support to bring us lower. Here, you saw this mitigation block fail here, right? And pretty much these are your entry models completed, right? Your next step would be your second stage of distribution, which should be here. But we did see this fail, and this is why price came up even higher. Does that make sense? And then there was another example here, I believe, where you had your high here, probably some form, doesn't have to be some form of SMT. We come up, right? We sweep the high, we sweep a high here, right? What happens? We come up into a rejection block here, right? We come up into the rejection block here, right? Now we can look for the next idea, which would be your order block to form here. Now you have your order block that forms here. You have your fair value gap that forms here, right? And this is kind of the order that everything happens in here. Order block, fair value gap. This was very strong displacement. So usually I would wait for the order block and the fair value gap to be the order block to be hit before the fair value gap. But if the fair value gap it's inside the order block, just like the breaker block, I'm okay with it. Not too big of a deal, right? And then you had your breaker get formed down here, right? And once again, this kind of qualifies this part again. Your high, we sweep the high here, make a high here, come onto your rejection block here, come into your order block and fair value gap here. Then you have your breaker block here, and we failed to make your mitigation block down here. Does that make sense? Right, and you can. So what are the chances of price delivery and continuation after failure in one of these stages? So are you saying like let's say here we failed, like here again we failed this mitigation block here. What are the chances that we fail this and continue higher? Is that kind of what you're saying? Yeah, so that all happens with within context here, right? So in this context, right, this cell model, right, was completed relatively quickly. And the reason why this cell model was completed relatively quickly here is because if we take this leg to this leg here, right, we came into um equilibrium back of this range here, right? We are in bullish price action ideally up to this high here, right? This was the high we're ideally looking for, right? We came into that, we were in this 15-minute BISI, this 15-minute breaker block here, right? So you do have to look for that context and see what happens here, and then that's why you can anticipate. Well, let's say if, well, let's say, let me see if I can find a good example here of something happening like that. When something fails. I'm not sure if I can find a very good example of this off the top of my head here, but yeah. Yeah, I don't think I can, but it really just depends on exactly where your bias is and what's the higher time frame job, what's the higher time frame doing, right? Like if we're on the 4 hour here, right? And we're looking at this 4 hour cell model here. Yeah, exactly. Yeah. So you just have to identify where your target or where your terminus is going to be. Your terminus does not always have to be the OC or the original consolidation, which would of the cell model, right? Which would be down here. This does not have to be your terminus always, right? Because what's the market supposed to do? Well, the market's supposed to rebalance inefficiencies, imbalances, seek liquidity, rebalance equilibrium, right? And what did we see happen here? All right, we did rebalance those right here. And we did come back down into equilibrium here. Right. So it's really up to you to depend and to see where your cell model is going to end here. Right. If we're taking your standard deviations here, right, off of this, like here, you hit your 4. off of your breaker, you hit your 1 to 1.5, right? So that's your low hanging fruit. No, it's not in order. That's just it's just a saying. Like it's not in any specific order. It's just like me saying, just listing three things. Does that make sense? Like it doesn't like it's not in order in any way. It's just that that's what the market's supposed to do. That's just what it's supposed to do. In a perfect world, yes, that's gonna be your order. That's gonna be your that's gonna be every time. But there are times that it doesn't happen, right? There are times like here where you're not gonna see your rejection block get hit here, right? Your rejection block's gonna be hit. It's gonna be right here, right? There are times where you're not gonna see your rejection block get hit here, right? And this is where ideally your SMT is gonna come into play. I have no clue if there was SMT here, right? But once again, here I'll kind of go over what is interchangeable and what's not. Um, like I would look into it, but I'm not always looking into it like that. I'm kind of just I'm looking more for like a market maker model uh out of a higher time frame imbalance. For example, let me see if I can get a good example here. Hold on. Okay, yeah, I think it's probably a good example somewhere here. It's low key better on the I think it'd probably be better to look at on Forex, but I'll see if I can get a good one here on NQ, right? Nah, no real good one on NQ, but here's the idea, right? You come into a weekly fair value gap here, right? For your market maker model, right? You're gonna look for that. You're gonna look for that 4 hour you're gonna look for that 4 hour market maker buy model. Where the fuck is this shit? Oh, it's right here, right? You're gonna look for your wrong fucking one. Okay. You're gonna look for your 4 hour market maker buy model here, right? And this is what we're seeing forming here, right? Out of your weekly, right? So what do we look for out of the 4 hour here, right? Off off 4 hour we come down, right? We're looking at the 15-minute next. So inside your 4 hour imbalance, you could have a 15-minute market maker model, right? Come into its 4 hour imbalance here, right? You have your next market maker model here, right? You have your 15-minute market maker buy model, right? Buy side of the curve here, just like this, right? This is your next curve here, right? Now, you come in here, right? Where this price come into here, comes into your breaker block right here, right? Comes, makes this low here, right? Comes into this rejection block here. Boom, comes in, boom, here's your order block. Boom. After your order block here, you get like a fair value gap somewhere here, right? And this is how you can kind of confirm what's going to happen outside of these higher time frame PD arrays and kind of confirm exactly what you want to do. And that's all with the market maker model since time is fractal, right? Out of the 4 hour, you want to look for that 15-minute market maker model. Out of the 15-minute market maker model, you want to look for that 1 minute market maker model, right? So what do you see after we come into this 15-minute breaker block here, right? We see our 1 minute market maker model higher, right? Now, not the cleanest, but it's still a 1 minute market maker model that comes out of this, right? And that's kind of the idea behind it. That 1 minute market maker model, right?
All right.
Do I use
We're getting
daily buy?
we're getting a little off track here.
You can stop the video.
Um,
I'm just answering
yeah,
questions.
yeah, yeah, yeah. So I'm gonna stop the. I'm pretty sure you're done with talking about times and macros. All right.
Yeah, I'm done.
Yeah. Okay. Since we're
Yeah.
done with that, the recording will be posted, but we could do a quick little like question session here. Yeah, I'm not gonna stop it. No. Um, Exotic, if you're fine with it, we could just like answer a couple questions and then we could be done
Yeah, I'm
in
cool with
around
that.
like 2 minutes.
Yeah, we'll do some rapid fire
Alright,
questions.
bet,
And then
bet.
one set question. So,
Yeah,
do I
no,
use daily buys when trading? Oh wait, what do you guys say?
no, no, recording's gonna be posted soon.
Okay. Do I use